All right, everybody. Well, it's great to be here. Obviously, we've got a conversation between two people who I've come to know in the last couple of years. Well, Jeff, we started to know each other, starting about a couple of years ago through common friends. We live in Palm Beach County as well, so we have that, and we're getting to know each other. And then, of course, Ted, I think we've only met at this conference last year briefly, and then we've sort of gotten to know each other through commonly held discourse in LinkedIn. We have a lot of the same thinking. So it's been really a pleasure to get to know both of these guys. But they share a common thread in terms of being wonderful practitioners of our discipline in improving client outcomes and managing risk better, right? Which is something that's really close to my heart, if you know me. But they come from totally different arenas, right? And I think we'll see some of those differences borne out. So Ted Hicks here, he's a founder and CIO of Hicks Associates Wealth Management. Hicks and Associates Wealth Management. He runs a boutique RIA where he's the strategist, and of course he's sitting across the table at the same time from the clients when things get tough. He recently wrote a book, Evidence-Based Investing, which I read. It's very good. I recommend it to everyone. Makes a compelling case that most market myths aren't just wrong, but they're outright dangerous for client outcomes, and that's something that I also believe is totally true. Jeff Zipper, he is one of those CMT CFA combination guys who operates in a large trust bank environment, so kind of totally a different realm really when you think about it, running portfolios on the institutional level, but also managing high net worth client accounts. And he literally sits in a building where people don't use or understand technical analysis at all, if that's pretty correct.
It is. In the private banking world, and I know that there are some that are working for bank or trust companies here, some are CIOs, but unfortunately, market analysis, CMT, whatever you want to call it, technical analysis it's used, but it's not used as much as it should in the private banking world. And I have to leverage Matthew's presentation 2 presentations ago when he compared institutional or professional portfolio managers and a retail investor. And when I saw some of those slides when it talked about being a professional portfolio manager, that sometimes you can't make a decision in a vacuum, has to go through a committee. I'm on some investment committees. That's where the technical analysis really comes into play, but it's more structured. There is a focus on risk. It's really risk-adjusted returns versus just expected returns. So it's working within the 4 walls, but I think technical analysis can work in that world when you're looking for not shorter returns, but maybe longer term returns. I think identifying trends, identifying where the risk is, and living by a few principles that I think as technicians we all sort of follow, and that's the trend is your friend, don't fight the Fed, and of course we've heard it a few times the last 2 days is bigger the base, larger the space, and sometimes that is hard to communicate to high net worth and ultra high net worth clients that just don't understand it. And there's so many questions I could share with you that come from these clients that don't really understand markets, where technical analysis really comes into play, and it really helps. And there was a slide, the ProShare slide was really good on silver. We discussed that. So when I see all those inflows and I see an overbought, and technicians yesterday discussed that, from my perspective, if a client wanted to add it to a portfolio, I'd say now is not the right time. And that's the why. The why is the technical analysis. The what is really a fundamental side, being a CFA as well. I tend to go to charts first. That's the what. What are the markets doing? Bull market, bear market, trendless. And then the why, what's the fundamental reason behind it? I know I'm going on here, but there's a point here. It's really looking at 2025, which really worked for asset allocators and client portfolios, and that has been emerging market, developed international, gold and silver. And a lot of times meeting with high net worth clients, when you talk about allocations to international, whether it's emerging markets, pre-25, it's like, well, it's never worked out. I've never seen alpha, and it's probably going to do that again. I would say, can you expand on that? Why? And there's usually no answer. So my answer is putting it together, both technical and fundamental. Well, the chart is saying it's going higher, and look at the fundamentals. You have earnings estimates going up, and then you compare valuations. It all makes sense. Sign me up. Everything is coming together, sort of a fusion strategy.
Yeah, well, I think that's a good way to kind of get the ball rolling here, and just to frame the conversation a little bit more definitely. Tyler Wood, he points out, and I thought this really fascinating to me, just having been a part of the organization since 2007 and a CMT since 2008, that wealth managers, stewards of capital, are increasingly becoming the primary membership of this organization, right? So it's not just sort of sell-side strategists, newsletter writers, et cetera. But despite that, that we are stewards of capital now in this industry, you still have these misconceptions out there, right? About technical analysis and what it is, that it's short term, that it's only for traders, that it's voodoo, whatever you want to say. So I want to just frame this conversation around how we can become better communicators in terms of what we do and its value, and how it strengthens those outcomes for clients, which is really the goal, right? Or it should be the goal. So with the first question for both of you, how do we close that credibility and trust gap for many that think what we do is, closer to astrology than it is analysis? Ted, you wrote that the failures in technical analysis are more the result of misuse, right, rather than indicators. So I thought I want to kind of you elaborate on that. And then Jeff, you work in a place that you just sort of elaborated on a little bit, where it's almost as traditional and sort of stodgy and vanilla as you can get. How do you guys, in a bank situation like that, approach this topic?
So, first of all, I don't remember writing that, so I don't know that I can respond to that. But when I wrote the book to kind of address some of this, the book started as an expansion of a white paper. When you talk to folks in the RIA world, marketing experts, when you go to a website, hey, Mark, before you leave, don't you want to give me your email address and I'll give you something free? And so I was told I should have something like that for the website. So I wrote a white paper because I don't really like the canned content that is so prevalent in the RIA world. So I wrote a white paper, and it was really hard. By the way, I'm convinced at least 10 people have read that white paper. But it was hard to be brief. And then my dad always wanted to write a book, and so I just kind of wondered, do I have enough to write a book? And so then, as the divine would have it, I ended up listening to a couple of podcasts that were geared towards the RIA world about advisors writing books. It's got to be short, but it's also got to be something that a client would read. So I really strive to write something that hopefully everybody in the room would enjoy, but also a client would actually get something out of it, and they would actually leave the book with some understanding of, they're not going to understand how I'm doing what I'm doing, but they understand that there is a method to the madness, and hopefully it reduces the number of questions, especially from certain clients that ask way too many questions.
Yeah, I think the way it can help it, at least in my world, in private banking or wealth management, is having it helps with a conviction. When you see something, a trend, a story, where the market is. I mean, obviously, 2025 and coming into this year, profit margins are high, earnings estimates are going up, not just domestically but internationally. But then if you look at the charts, you can see that the trend is firmly in place, and I'm a big believer until a trend changes. And you could have any sort of time frame, but for me in my business, it's really, I'm looking at more weekly, monthly charts, longer term, because I'm not looking to trade in client portfolios. Again, your presentation was great, the 5-year situation. We were looking for trends further out to put client assets into, but I can't tell you how many times when I'm dealing with portfolio managers that don't use technicals, and I sort of convey what I'm thinking I'm seeing, and I turn out to be right. I often hear, and some people are going to laugh, that, hey, you were lucky. No, it's not me, it's what the market is doing. It was very easy to see. It's as clear as day, and that's how it's really helpful in what I do. And also the intermarket piece is really important, understanding how different markets, again, I'm going to go back to your presentation because you had everything. I'm picking on you because it was such a great presentation. I'm sitting there thinking, it's like, really, this is really central to what I do with the different asset classes and why and what they're doing based on what another asset class is doing. It's really powerful when you convey that to clients.
So I would add one other thing for you, Matthew. One of the phrases that you use is a little hard as a tongue twister, but I say something very similar. A chart is not predictive, it is suggestive. It's a little easier to say. And that's when I'm explaining the concept to a client. I don't know, or we'll talk about intermarket analysis, and I'll explain to them briefly what it is. Intermarket analysis, in my opinion, doesn't tell you what to do, but it does tell you where to look. And then it's a matter of having a conviction of there's a method to the madness. And again, that's arguably why I wrote the book, but I really tried to help the client, the average American. My wife, a week before our book launch party, she came to me kind of sheepishly. She hasn't read the book, and somebody was challenging her, you haven't read your husband's book? And so I kind of feel like I should read it. I'm like, well, yeah, honey, I kind of would like you to read the book, but I'm not going to make you. So a week later, and the book is over here, so it's not a long book. And about a week later, she came to me, and she had this look on her face like, I can't believe it, but I understood it. And that's what my objective was, but also to explain that there's a method to the madness, and this is what we're trying to do. And what I'm finding here, especially lately, is some of the conversations I'm having with prospective clients is they come to us when they've already accumulated a lot of the wealth. And their job is, when they're handing it over to someone like us, it's like, don't screw it up. Well, yeah, this is our process, and this is how we do that.
Right. No, I think that's great. So really simplification to change minds is sort of your perspective because you're dealing with that audience. Now, Jeff, obviously you're dealing with a different audience, including your internal colleagues. What arguments do you make to sort of knock those walls down and disarm those folks and actually change minds? Like, what have you found? Like, what approach works for you?
Well, yeah, I mean, even in 2025 in discussing sectors and asset classes and, even internally there are some, international hasn't worked. It's not going to work for clients. Why should we even equal weight or overweight? And for me, I just saw the trends starting. So it's really just, as I said, sort of fusing both the fundamental or the quant with the technicals, and if it all lines up. And then even yesterday on John Calvos, forgive me if I mispronounce your name, had the Elliott wave. And I'm looking at that. That is so powerful because for me, what I like doing is I like to read as much technical data from different people as I can and then form my opinion. The best part of it, if it all lines up, and then the fundamentals line up, it's like, sign me up. Let's go. It's perfect.
Right. So for you, it's a matter of giving them confidence through your triangulation of all these different resources and different approaches.
Right.
Yeah. That makes sense. Well, and I know you're a CFA and a CMT. I mean, I have to ask you, being both, which comes first in your analysis, right? And then how does that change, or does it change, depending on who you're speaking with or who you're trying to convince?
Is the CFA presenter still in the room? Can you walk out? No, just kidding. Just kidding. No, I use both. I'm proud of both designations, the CFP as well. But personally, I go to the charts first, and I use the fundamentals to back it up as to why it's going on. Like, for example, I mean, gold is a perfect example in 25 where, you know, dollar's weak, right? So there's a high probability that commodities or gold or precious metals are gonna do well. But then you see the central bank buying, you see interest rates, you know, interest rate lowering regime. But then a chart that really resonated was an increase in government debt with the price of gold right next to it and seeing how correlated it was. So again, I'm looking at this and it's lining up. But today, if I had new client money come in, would I be buying precious metals today? I wouldn't. Right. Because of the run-up. I just felt it's gone parabolic. I'm seeing that the pro shares, I'm seeing those inflows, gets me nervous. However, on an intermediate longer term, the trend's not broken. I will look for a retracement, right? The Fibonacci comes in. So you use all these different tools to figure out, you know, entry and exit, not just securities, but asset classes.
Right. Yeah, no, that's very interesting, and I think it kind of goes more to your style of sort of gathering that evidence and forming your own opinion. Now, Ted, from a evidence-based technical analysis perspective, do you think a fusion approach makes it easier or harder to maintain discipline for you?
I'm not sure. We do look at the fundamentals if we're buying a stock, but we look at them for about 2 seconds. It's just the stuff at the market surge or market smith at the bottom, but the chart leads. If it's got horrible fundamentals, but the chart is saying what we want it to say, we'll still buy it.
Right.
He's much more into the fusion, and I would argue to some extent it's because of the types of clients he's blessed with working with versus the folks that I'm working with. It's a little bit different.
Right. Well, I just think, you know, the reason why I bring it up is because with individual investors, oftentimes you're talking about stories, right? And stories are often embedded in sort of fundamentals, and you know that could be hard to override. I know in my past, early in my career, I got wedded to sort of a thesis that I had, right? And you hold stocks too long, or it just doesn't happen, or doesn't come to fruition. So that's why I'm sort of asking, because your client base is like that, right?
So one of the things that we will talk about with our clients is try to sometimes explain to them, the CEO's job of whether it's Tesla's, Elon Musk or whoever, the CEO's job is to run the business, but sell the business, and he's telling a story. So why is this stock going up? I really don't care why it's going up.
Right.
Or sometimes we'll ask them, and I say this in the book, Mr. Mrs. Klein, do you want to be diversified? And no, you don't. You want to be long 100% Microsoft 1973. Oh, well, yeah, when you say it that way. Yeah, so does it really matter what you're invested in? Or does it really matter that don't get me wrong, we have some diversification in the portfolio, but if it's going up, who cares what it is? So do I try to explain why gold is going up? Rarely, honestly.
Yeah. No, I think that's
So if I was in that situation, the chart looked fabulous, but the fundamentals were not backing it up, I'd be really curious to know why and what am I missing? And if I can't figure it out, then maybe I would stay out of it, because to me, it's really important that they confirm. And to your point about wealth creation, and we talked about this last night. I'm not sure if it's Fidelity or Schwab, but one of the two. I saw this blurb, and it talked about, they went back in time, I don't know if it's 50 years, but the best performing portfolios were two types of portfolios. There was no turnover, and the people were deceased. So I'm thinking, like, well, how's that possible? Well, concentration creates wealth. Diversification keeps wealth. So that's sort of the business that I'm in, is the diversification and not the concentration. But I would be, and I see it often where technicians will say that, well, I don't care what the fundamentals are, that everything is lining up, it looks great. To me, I might have a yellow flag on that. And I could be wrong.
Right. And it could be a missed opportunity, or maybe not. Yeah.
From our standpoint, it's just, what's the exit strategy? So if it's, again, if it's going up but I don't understand it, as long as I feel, or our analysis is that it's a low risk entry and we can determine in the chart before we get in where we're going to get out. Who said it? Was it Lundgren? I don't remember who said it. It's okay, maybe it was Dave Keller. It's okay to be wrong. It's not okay to stay wrong, right? So where in the chart am I going to know that I was wrong? And do I know why it's going? I don't care, but right there it says I'm wrong, so we're out.
Yeah, no, that makes sense too. Now, one of the most damaging myths that Ted talks about is the idea that risk is passive, and that investors, have to stay the course. This idea that investors have to stay the course, and that if they do, that volatility just takes care of itself. This I think is a big one to me personally. How do you use technical analysis to reframe risk as something that needs to be actively managed?
So every Christmas, at least for the last 2 or 3 Christmases, I'm kind of surprised somebody in my family has given me a chart of the S&P 500 from 1965 through 1979, because I show it all the daggone time. And it's in my book a lot. And so what I try to chat with clients about is, imagine you're on the left-hand side of that chart. Explain to me over the next 15 years, is the last 15 years of your career, are you still a long-term investor? And this, I walk the reader through this in my book. I believe most people think that there are 2 types of people in the stock market. You're either a short-term day trader or you're a long-term investor, and I think that's baloney. I think the vast majority of people are somewhere in the middle. And again, the folks that we're working with are getting really close to retirement, and we recognize that long-term downtrends happen when we're not expecting it. Yes, we're going to look at the fundamentals. We're going to look at the economic data, and I'm going to try to anticipate these types of things. And some of the things that guys were showing today, hey, you might want to stay alert. Well, we are alert. That's our job. You use the word steward. We take the job of a steward of other people's money. We take that job very seriously. So we're paying attention, and we're not afraid to shift into cash. One of the other examples I use in the book is driving. I currently drive a Ram 1500, but I used to have a BMW 550. And there was this one particular spot, and you're coming down the Durham Freeway, and you're going to go west on I-40, and man, it was just beautiful curve. And Clinton, you might be familiar with that stretch of road. There's no speed limit sign on that entrance ramp. So I'm going to push that daggone car as long as the conditions are right. But if the conditions aren't right, I'm going to alter my driving. Well, if I'm going to do that for driving, why wouldn't I do that when I'm managing your wealth? Now, again, to some extent, it's also a function of who we are typically serving. 70% of the assets that we're managing are in qualified accounts, so it doesn't matter. There's no tax consequences for us to shift and to put the car back in the garage, and then we can shift right back. Now, Schwab just announced they're going to do $5 trading costs per account for any time we use a not held order. We've been using that a lot, so we might have to change some of what we're doing, but you're at the point where you're almost retired. We can't afford to just assume it's going to continue to go back up, so we have to have a strategy. So one of the things that we will also do is, in the book I show the example of the VSI indicator. It's just a proprietary indicator that I've made up. It's a nod to my love of aviation, Dave. And I have an S&P 500 chart, a monthly candle chart, and it's color-coded. Darren helped me color-code it. And so what if we only invested during the green candles? And again, and I will show them, it's not perfect. It's not designed to get us out at the top and back in at the bottom. That's not what it's designed to do. It's designed to help us determine, to your point, what kind of regime are we in? Are we in a risk-off regime, or are we in a risk-on regime? And that might affect what we're going to do. And when the clients can see that, they get it. So I'm just really trying to make it really simple so the average client understands that we're going to take the risk aspect very seriously. And the last thing that I will, Julius, you were talking about special forces. I'll use the special forces as an example. Are the Navy SEALs aggressive men? Well, I would argue they are aggressive, but are they always aggressive? Are they always on the offensive? No, they're not. They're going to pick when they're going to go on offense, and they're going to pick when they need to have a tactical retreat, or why wouldn't we do the same daggone thing? You don't always have to be well, I'm aggressive. Well, right now it might be stupid to be aggressive.
Right. And Jeff, like kind of an adjacent question. So in the trust bank setting, how do you justify, tactical risk reduction without being accused of being a naughty market timer?
Yeah, well, I think over the last 2 days, doing sector work's important. And when the last 2 days here, I heard healthcare. So I think hearing different technicians, and I sort of agree in 2026, healthcare, and it's leading right now. And if you use some of the data with midterm elections, healthcare and usually does well. The valuations are there. The charts look good. So to answer your question, it's really being tactical with sectors and asset classes. So right now, the Mag 7's been brought up a lot. So only 2 out of the 7 outperformed last year. They haven't made a new high since October. So that's an area that you'd want to underweight right now going into 26, maybe overweight healthcare. So look to those sectors. And oh, by the way, mid caps and small caps are taking off. So that's areas you want to look to. So being tactical, sort of always being long, but being tactical and overweighting asset classes, underweighting asset classes and sectors as well.
So being tactical relative at the margin, basically, is
Yeah.
the answer. Yeah, that makes sense. Well, the next thing that came up, in a lot of the conversations that we had today, and certainly it's central to the way I think too, is this idea of regime identification, right? And this question is going to be for both of you guys. How do you define a regime change, and then what tells you if that regime change has either not going to come to fruition, i.e. it's wrong, or something has sort of changed in the meantime?
So most of our clients have exposure to 4 different equity strategies. 2 of them are quant and 2 of them are tactical. And the 2 quant, they're different quants because the timing, the signals are going to be different. That's why we're using 2. And so those are our anchors. And then we will supplement that with the tactical strategies. And so that's my answer, is if the quant models are telling us, giving us a sell signal, well, that's a regime change of some variety.
Right. Okay, so just systematic, basically. Yeah.
Yeah, so from my perspective, when I hear regime change, I
Think Venezuela?
Yeah, well, I was going more fundamental side of news cycle. For example, defensive public companies being asked not to pay dividends. I mean, I've never heard. So that could be sort of a regime change for that sector. If there's a mandate for them not to be able to pay dividends and pay shareholders, and when I think regime change, I think the Fed. I think interest rates. How many times are they getting lower rates this year? So to me, regime change is more on the fundamental side, more of the macro than it is than technicals. I mean, obviously in technicals, if you see a sector or an asset class breakdown or you see it break out, I will say the looking for long bases, whether it's up or down, is to me the pinnacle of regime change, on technicals.
So a little bit more, I would say, opportunistic,
Yeah.
and sort of flexible in that sense.
Yeah, I mean, so for example, healthcare, I saw a technician somewhere, and I tried to figure it out, but I couldn't, basically saying we're in a 17-year base in healthcare and we just broke out of it. So that to me is sort of a regime change, and that's the light bulb going off. It's like, I need to be looking closer at this sector.
Yeah. Well, and another question for you, Jeff, because I just think it's, again, such a different world that you live in. How do you reconcile probabilistic thinking, right, with institutional demand for clarity, right? Like they want to know, like, this is the answer with some sort of absolutism. Is that something you struggle with, or how do you get around
No,
that?
I think you mentioned that the word probability is used a lot, probability.
Yeah.
So based on what I see, higher probability, lower probability. So give you an example, coming into this year, if you wanted to allocate to technology and you had funded a portfolio with cash and you wanted to get invested in day one, I would say between now and the midterm elections, you have a higher probability of losing money on your investment. If your time frame is short, Obviously, if it's longer, the fundamentals are there. You could argue it's oversold right now, but short term, so you have to think about that, the probability, short, intermediate, long, of what the capital is going to do.
That's a great way to sort of get around that backing yourself into a corner, right? Next sort of goes in conjunction with risk, and something again that is really important, I think. And Ted argues in his book that avoiding the large drawdowns is mathematically more important than capturing marginal upside. And by the way, Ted, have I told you how much I love you? Because this is exactly the way that I think, and it's the way that the mathematics work, right? In terms of if you avoid those big drawdowns, how does that affect compounding? And then, of course, when you talk about sequence of return risk and all that stuff, how does that principle shape your exit rules? And this is again for both of you guys. But
so in our tactical models, we're trying to pay attention to the math. What's our average win? What's our average loss? What's our batting average, et cetera, on our tactical models? Because again, we're trying to manage that downside risk. And clients, once we've explained that to them, and one of my clients who's really kind of a pain in the neck, he read the book, and he's like, it was really good, and it should be required reading for all of your clients. So far, he hasn't asked me any more questions. So that's why I do it that way. Stop asking me questions.
Yeah, I like discussing risk-adjusted returns versus just relative or absolute returns. And I think the risk issue is really important, because whether it's a retail investor, high net worth, ultra high net worth, most of the times they're just focused on the expectations for returns. And when you can incorporate asset classes that are uncorrelated, so I'm kind of maybe regressing here a little bit, uncorrelated alternative investments, long, short, hedge funds, just something that's uncorrelated to your equity or bond portfolio would be helpful to manage downside risk. But that said, I'm a big proponent of always having cash in a portfolio. Right now, money markets, about 3.5%? I mean, what's the demarcation line that you get that $6 trillion of retail bank money market assets into the market? What percentage of that? It's at $6 trillion. Is it going to be 2% money market? I don't know, but I think it's important, because when you have a situation where a market retraces and you get a spike in the VIX, to me, in my experiences, that's always been a good time to put money to work. So I look for that. I'm hopeful to get that. And I always tell clients you're going to get that maybe 2 times a year, maybe once, and you want to have cash available to utilize it.
Mm-hmm. Yeah, so taking advantage, again, being opportunistic, a little bit more flexible,
Yep.
Focused on the asset allocation to sort of dampen the volatility. So follow-up question here. So Ted, as a sole decision maker, right?
I'm married, so.
Right. Outside of the house, let's just say. How do you enforce discipline in the face of client FOMO, right?
That's a good question. And so there's 4 of us on my team. And if you think about the 3 kind of divisions of the team, I sit over each of them. So Karen and I run the business, Paul and I meet with the clients, and then Braxton and I run the portfolios. And to some extent, Braxton, you could argue, is an accountability partner. So he and I are accountable to each other, and we're just studying the numbers. And yeah, I know, Mr. Client, we didn't buy NVIDIA at this, or we got stopped out of that. It doesn't matter. It's, again, the joke that I tell clients all the time is the way that they analyze their statements is they get the statement in the mail, they look at the opening balance, they look at the ending balance, and say, hey, honey, what's for dinner? I mean, that's it. It doesn't matter what you're invested in. The math will work itself out if we're in the right things. And again, it's a function of what we're doing and who we're serving. Now, the Lord blesses the business, and all of a sudden I'm working with a lot more of the ultra high net worth, and the makeup of my practice shifts. Right now it's 70% qualified. If it becomes the other way around, I might have to change some of what we're doing. But the vast majority of the time, it doesn't matter. It's math.
Right. And Jeff, sometimes you have it in a committee environment, right? I mean, so in that environment, how do you act on some, like, if you see deterioration, right? Or if you see opportunities, how are you able to sort of act on that in a timely way, right? Because sometimes when you're talking about a bunch of people in a room agreeing on something, that's just hard to do.
Yeah.
How do you handle that?
Well, I want to address the question that you gave to Ted regarding FOMO, and what I have found that, and I know, knowing you, that your process is very rules-based.
Right.
And I think when you manage money professionally, you want to stick to your rules. So when you have clients that bring up the FOMO issue, it sort of impedes on your rules. You know, why aren't we doing this? You know, you gave us discretion to manage your money. We're your asset manager. So by you communicating this, we certainly, you know, want to discuss it and file it away, basically. But when you start impeding on a rules-based process, it's going to affect performance, and it's going to affect how you allocate money. So I think that's really an important issue. So to your question, when you're on committees and it's a voting mechanism, and not everyone follows technical analysis. Now there are some that want to be technical analysis, and they use it to try and fit their narrative. So they want to justify something. Can you find me a chart that justifies this? I'm like, that's not how you use it.
Yeah. So when it's convenient for them.
Yeah, exactly. So you run into some of that. You just have to make your argument, and it could be fundamental, it could be technical, it could be both. Just have a conviction.
Right. Yeah. No, that's good. So switching gears a little bit here to ourselves, right? Reflecting on our own behaviors. What, and this is of course for both of you guys, what behaviors has discipline in technical analysis helped you eliminate from your own process or demons in terms of investing and decision making?
I think it was Mark Minervini in one of his books said something along the lines of, if you're going to be disciplined in one thing, you should be disciplined in everything. So as much as I slept really bad last night, I got like 3 hours of sleep, but I still woke up and I went to the gym and the hotel, because if I don't do it every single day, I'm going to fall off that wagon. So I'm trying to maintain discipline in everything. I ain't perfect, don't get me wrong, but that correlation helps. If I'm going to be disciplined here, it's going to help my discipline there, because it becomes a habit.
Yeah, I agree with that, and that's something that, as you meet people and you talk to them personally, hey, you kind of talk about, what are your hobbies or what do you do? And when people talk about, taking care of their body and training and lifting weights or running or whatever it is, I immediately get an impression of, discipline from that, right? So.
For me, being a successful money manager is making mistakes along the lines and learning from those mistakes. And those mistakes usually happen when you don't follow your discipline. You have rules, you have a disciplined approach, and you deviate it. I brought it up just a minute ago about trying to having something fit your narrative. So if you want to place money personally somewhere, you're trying to justify it, and if you deviate from your discipline, you could lose money doing it. I'm just talking personally here. So for me, making mistakes in the business and learning from the mistakes, I think that makes you a better money manager, better asset manager.
Yeah, I think you're right. And the more expensive the mistake, the faster you're going to learn it, learn from it, right? And I think it's just so important. Yeah.
Dave Lundgren mentioned something yesterday about books that he rereads, and I think that's part of it too, is rereading some of those classics that just reinforce the concept, especially on our tactical side, the way that we do our tactical models. We have to stay disciplined, because if we don't, we're going to end up with too big of a drawdown, and hope is not a strategy. So we stick to the process and have faith that our process is sound. We're just, it's just the market environment. It's that regime, but it will get better. And if we've stayed with our discipline, we will have that. We'll be right where we want to be.
Right. Well, I'm told we have 5 minutes left, so I want to make sure we get to eat soon. So in terms of what I just want to say, I have two more questions here. So one is with reference to active risk management and just sort of being able to talk about active risk management without apology, right? And I struggle with this myself, honestly. I think many portfolio managers feel compelled to defend tactical by saying, we're not market timers. But is that distinction still useful, or does that sort of undermine, just by saying that, just sort of undermine credibility and almost draw attention to the fact that you're trying to use different words or talk around that?
I don't mind telling clients we're timing the market and we're timing our positions. That doesn't bother me personally. Who knew we were going to invade Venezuela, right? I didn't know that, right? Mm-hmm. And I think before World War I, if memory serves me correctly, the markets went down. World War II, the markets went up, like the day we invaded or whatever. It's like, you don't know what the market is how the market is going to react to this, or the market is going to react to that. So we just stick to the discipline, because again, the majority of our clients are trying to preserve capital. We want to grow it when it's appropriate to grow, but we need to preserve it when it's appropriate to preserve it. And I don't know what tomorrow is going to bring.
Yeah, I would answer it this way. So everyone knows that clients in up markets want relative returns, beats, and then in down markets they want absolute returns. So they don't want to lose money. So you have that client that you're not going to lose any money, right? And you're going to, in equities, you're going to get out of the market for, you get a 10% decline. But that's not the case. So it's really about, in my role, it's really about the strategic allocation, longer term, how you want your assets placed, and then, to your point, Vince, it's the tactical. Where do you think you can provide alpha and also reduce risk in a portfolio?
Right. All right, and the last one, I think this is an important one, and hopefully one we could all sort of think about on our own. But what's one myth that you wish this audience would stop tolerating because it actually harms all of us professionally? What's one of the most damaging myths out there?
I'll start. I think when a technician has a good handle on a security, whatever it is, has a price target, usually a minimum price target, and it's hit, it's not luck, and that's what some in the industry that are not using technicals would think, versus a fundamental analyst will base price targets, dividend discount model, earnings estimates, and would not even look at a chart. So that's the myth that I don't like tolerating, is that the technician's right, give them credit. Right. They called the price target, everyone can see it, versus trying to figure it out based on earnings expectations.
Mm-hmm.
I don't have anything to add to that. I can't think of any myths that the people in this room are perpetuating. The myths that I just trying to take apart in my book is the myths of the industry and the stuff that they keep preaching that just doesn't work. That's the myths that I'm trying to take apart in my book, which is on Amazon. You should get a copy. Then leave me a review.
By the way, if you didn't see Ted last night, he was the guy with the cowboy hat. And I told him I'd pay him $20 if he wore it today, so I lost that bet.
Gentleman doesn't wear his hat inside.
That's right. That's what he keeps telling me. Okay.
You're rules based.
I'm rules based.
Yeah. Well, thanks, guys. This was a lot of fun. Appreciate it.